It's policy day today, and the spotlight will be on RBI Governor Urjit Patel as he delivers the first monetary statement of FY18. Now, the markets seem to have factored in a status quo by the committee as investors don't expect any surprises today. We at ET Now conducted a poll of top analysts and bankers. Poonam Sani gets us the findings. Poonam?
Well, most likely RBI is likely to retain their status quo in terms of the rates, and also the neutral stance is also likely to continue, but the entire focus is likely to be in terms of liquidity management. Note ban has led to nearly around 4.5 lakh crore of liquidity surplus in the system. RBI's commentary in terms of how much of this liquidity is surplus in nature and the durability of the surplus would be the other thing to be watched out for. RBI has various tools, and which tool does RBI use to manage liquidity would be important. 95% of the respondents in fact do not see a CRR hike, but 5% do expect a CRR hike, and do know that CRR does come with a cost, as bankers do not get any interest paid, and hence it does come in the way in terms of further interest rate cuts from the banking system. A standing deposit facility is something that economists think can be used as a long-term tool along with the OMOs. So watch out for commentary on that front. Standing deposit facility may need an amendment to the RBI Act. Having said that, RBI is also unlikely to change their growth forecast, but RBI's commentary in terms of the note ban impact on growth would be important. Inflation concerns have slightly receded, but El Nino may stoke further inflationary concerns. Recent INR appreciation and RBI's commentary on INR appreciation on growth and inflation would be important. RBI is also likely to remain cautious in terms of the global macros, and also RBI's commentary in terms of stressed asset resolution of the banking system would be important. As of now, no rate cut, but the focus on liquidity management would continue.
Okay, Poonam, thanks for all the updates on the survey. And moving on, our consulting editor Maithili Bhusnur also has a take on what the RBI may do this time around. Listen in.
You cannot possibly have an accommodative stance and excess liquidity. The two cannot coexist, that is one. Number two, even though consumer price inflation is down, there is a huge debate on which the jury is still out on whether central banks should respond to asset price inflation. And what we are seeing, particularly if you look at the capital markets, there is huge asset price inflation. Now, should central banks respond to that? The jury is still out on that. What do central banks look at? Only consumer price inflation or asset price inflation? So while I would say there is no case whatsoever for you to change your stance or to cut rates, I think one has to be a little wary going forward.
And all eyes will be on steps that the central bank may announce to suck out the excess liquidity, boost credit offtake and tackle bad assets in the banking system. But economists say that there is need for drastic measures for culling out liquidity at this juncture. Let's hear out a few expectations.
See how inflation expectations are, the risk is on the upside at all. So to that extent, I think RBI should and they said that they expected, inflation to be at 5% by the end of March. It's well below that. So in that sense, I think what they said in December they should go back to that and say, well, our forecasts have been, much higher. The reality is much better. So we should, when facts change, intelligent people change their views as well.
What we have seen in core inflation, once we have taken out the impact of diesel and petroleum and transport prices, is that core inflation has actually fallen over the last 6-7 months' time almost by 100 basis points, from around a very sticky 5.5 to a slow drip towards 4.5%. That's a sign that there isn't very much demand in the economy. And I would say that till that number starts moving up and moving up quite aggressively, changing the stance of monetary policy or reacting to things like one-off measures like the 7th pay commission effect, or a jump in inflation rate or a jump in oil prices, I don't think monetary policy should react, and I don't think the RBI is going to react to it. RBI has in the past and will continue to look past this and see whether or not there is a genuine inflection in demand-driven inflation before it changes its stance.